Hello, everyone. My name is Justin Ruiss. I want to welcome everyone to our ESG and activist investing webcast fireside chat here, sponsored by Cision and Investor Update. Thank you all for joining us today. I'm very excited to be here talking about this very incredible subject with a guest panel here with some really great speakers. So why don't we meet our speakers and we'll jump right into the topic. First off, we have Andrew Archer, Head of ESG Advisory at Investor Update. Andrew, why don't you say hello to everyone, give us a little bit of background information on yourself, and we'll jump to the next panelist.
Okay, yes, hello everyone. So I'm, as Justin says, I head up the advisory part of the Investor Update, and my background has been in investment banking for a number of years, but recent years has taken me away from investment analysis, corporate advisory, into specific advice around ESG sustainability matters, and that's the business that I'm in today.
Great, thanks for joining us, Andrew. Next up, we have Gabrielle Wolf, Director in the Proxy Solicitation Group at Innisfree M&A Incorporated.
Thank you. I work at Innisfree. It's a high-stakes shareholder engagement firm, and we provide shareholder intelligence, strategic advice, and solicitation services to corporations and investors. And as Justin said, I'm a director in the Proxy Solicitation Group there. Happy to be here.
Great. And last, Amanda Klein, Managing Director at Gashalter Co. If you'd like to give us a little bit of background information, that'd be great too.
Thanks, Justin, and thanks for having me. I'm Managing Director at Gashalter Co., a strategic communications firm based in New York and Chicago. I've been doing this work for about a decade, and we launched Gashalter Co. as one of the founding members of the firm back in 2016. And we provide communications counsel and advice to corporations, investment firms, and work in special situations such as activism that we'll be discussing today.
Awesome. And I'm Justin Ruiss, Director of IR Activations here at Cision, and just wanted to say thank you very much, everybody, for joining us again. I'm really excited to have this conversation on ESG and activist investing. And this conversation was sparked by a white paper drafted and written by Andrew and team over at Investor Update. And I think it's very telling of where the industry is going, where the investment community is headed, and how ESG is playing a factor into this. So let's begin the topic, or let's begin the webinar here and direct this question for Andrew. How has ESG changed the landscape of communication and messaging within the investment community? Andrew, if you'd like to start by giving us your thoughts on that, and then we'll jump to some of the other panelists and begin the discussion from there.
Sure, thanks. So yeah, it's exactly the direction we took in the paper. And what I'd start with is saying that obviously ESG and its components aren't anything new. I mean, it's the growth that we've seen that has changed this landscape really. And it's over the last, say, 4 years, we've seen this growth in the scale of investment around ESG now close to $40 trillion, which is defined some way as being, that's about a third of overall investment. And it's that sheer weight of money that is having such a profound effect on the way that companies engage and they communicate with investors, I think. So there's the growth. But there's also the alignment. I think this is about thoughts and values and priorities around the environment and the consequences to societies, I think, and the consequences of falling short of promises that are being made. So I'm talking about alignment between institutions and the individuals within those institutions, but also between institutions and clients, and between those institutions and stakeholders beyond the financial and corporate world. So I don't think we've ever really seen alignment of such a level, at a global level. You've got increased opportunity, mainly because of the growth in expectations from investors. That's left many lagging in this area. But you also have a significant amount of value that's as an opportunity, an uplift that can be achieved by companies that communicate effectively and represent themselves well. So they can either take advantage of that value, create that value, or leave it on the table for others to identify and target. And I think that's really what's changed the landscape. That's what's made a big difference in the way the companies feel compelled, or they should do, in how they engage with and communicate with their investors at the moment.
Amanda, would you like to add anything to that, or do you have any follow-up for Andrew's comments? Love to hear your thoughts as well.
Sure. So I think that everything that Andrew touched on is correct. I think that we've definitely seen a push more from the investment community towards putting dollars where there is an alignment, as Andrew said, with good ESG practices. I think you're seeing it starting with the LPs into the managers in which they're investing, and then the managers where managers are putting their dollars into the companies. I don't think it's happened, very recently. I think we've seen this push over probably the past 10 years. It didn't just happen, last year. I think we're seeing more and more of it, but there's almost been a domino effect that's been happening. And as people lean in and lean in and lean in, we've reached a tipping point where it can't be ignored anymore. So I think that you're only going to see a heightened increase in where LPs are putting their dollars with investment managers. I mean, we're seeing a heightened increase in, DDQs and questions on DDQs related to ESG and sustainable investment practices, and then where those managers are putting their dollars in terms of, companies in which they're investing in.
Absolutely. Now that we have a solid foundation of how things have changed, we do want to invite everyone who is listening live here, if they want to submit questions, feel free to use the Q&A function that's given on your screen. We will be there live to help address these as best we can. So why don't we jump into the activist conversation here? And Gabby, I think this is more geared towards you, and we'd love to get your thoughts here. How are activists using ESG as an investment strategy? If you'd like to start, that'd be great, and we'll jump around the room from there.
Thanks. Yeah. This is not, I think the important thing is that this is not necessarily ideological. A good climate strategy just makes good business sense, right? We see the Biden administration is demonstrating that climate risk is a priority. The Treasury Secretary, for the first time, said that climate is something we need to address to protect against systemic risks to the economy. And the SEC is looking at mandating disclosure of climate risk. There's, people are using energy in different ways than they used to use it before, and countries are committing to net zero over time, net zero using less traditional carbon and over time. And so things are going to change, and companies need to look ahead and strategically plan for how their business model is going to change as consumers use energy in different ways. And I think that the way ESG activists, or any kind of activists, are looking at this is that it really has to do with the bottom line, right? Preparing for a shift in the way consumers use energy, shift in climate, shift in the way we think about it, the climate and climate risks, is just good business sense, and it's not necessarily a ideological concept as much as it really needs to be tied to the bottom line and profits. So I think that is one of the key things that folks who might have been looking at, for example, the big win that engine number one had against ExxonMobil might have missed, which is that while it was an amazing win for the environment, it was also really tied to capital allocation and short and long-term shareholder value.
Amanda, do you have anything to add to Gabby's comments? I'd love to hear your thoughts as well.
Sure. I think Gabby hit the nail on the head. I think that, frankly, there's been a lot of push on the ESG investment side, but a lot of the news around that, to date has been very much, what does this mean for the environment? What does this mean for sustainability? What does this mean for, net zero, et cetera? And even in the example that Gabby and I had the opportunity to work on together over at, the Exxon engine number one proxy fight, we had seen shareholders pushing Exxon for a very long time to do things on the environmental front, and even shareholder resolutions that had passed, but they weren't being implemented. And I think where there was success this time around with the engine number one fight and ultimately win of 3 board seats was that there was a connection to how these environmental changes and how developing Exxon for the future and for decades to come is going to impact shareholder value creation. So yes, it's good for the environment, but at the end of the day, we're also living in a world where money matters. And it made not only good environmental sense, but also business sense. And now, it's not going to be overnight, but we're going to see how that will play out over years to come.
Right. Absolutely. So Amanda, if you don't mind, I want to stick with you. Oh,
no, go
please.
Ahead.
Gabby, please. Love to hear more.
No, just picking up on that a bit, I think, and one thing Amanda mentioned that I think is important to point out about Exxon, which also makes it not necessarily a great precedent for other companies that might be scared of ESG activists, which is exactly what Amanda said. Exxon had taken an approach where they basically stuck their head in the sand and ignored a lot of the things that they were hearing from their shareholders over years. As Amanda said, shareholder resolutions had passed relating to sustainability and environmental risks. And they didn't do a good job of communicating with their shareholders over time. They kind of ignored it. And that made them even more vulnerable to an ESG activist like engine number one.
Absolutely. So Amanda, I want to jump back to you and get your thoughts. Which areas of ESG are most concerning to activist investors? Would you like to share, please?
Sure. So I think all 3 parts of the E, S, and the G are going to be important to activist investors, people that deem themselves as ESG activist investors and people that are just traditional activists. I think if you break down each of those components, the G at the core governance issues are, if you think about a proxy contest or what activists seek to do, ultimately they do go back to governance in some way. If you're seeking to launch a proxy contest, you're seeking to change the governance structure of a company by changing up its board. So I think if you're really breaking down each of those components, all things tied to activism, if you are going the proxy fight route, are in some way related to the G in governance. I think, more recently we've seen things tied to the E in terms of environmental campaigns that are tied to, long-term value creation, such as engine number one, and we've seen engine number one and Exxon, and we've seen, other situations come to fruition around carbon emissions and limiting that and how that can impact companies, future performance. I think that where we haven't seen as much, but we are likely to see more, is related to the S. And I think that, frankly, it's just a harder topic, so social issues to quantify. Workforce issues, labor issues, turnover, diversity and inclusion, those all really fall under the S. And I think that we're starting to get more data. And as that data becomes more quantifiable and put into numbers, we'll see more come there as well. So all of them have a place. I think the G has obviously had its place for the longest. E, has really come to fruition over the past probably decade, and the S is to come. And it's starting to come. I think that's where the conversation is really going to evolve.
Absolutely. Andrew, you're nodding your head. I want to see if you have comments towards that. Do you have anything else to share on Amanda's comments?
I do, and yeah, it is. It's very much the rise of social. I think is going to be the next phase of this. Environmental, clearer commonality of metrics, agreement on what might be important, not universal, but it's more. But social, what we've seen last year, particularly areas around supply chain and areas or casual abuse or by omission, we have seen significant risk, and therefore I think this is going to be an area of great focus going forward. And if there's opportunities to improve that, either operationally or more as importantly, the communication of that to demonstrate what's being done. And I think that's going to be an area of significant change, I think, and it needs to be.
Given those comments, I want to pose this to Gabby. How are target companies becoming more vulnerable to ESG activism? Given the conversation where it's been going, if you'd like to comment on that, Gabby, that'd be great.
Sure, yeah. There's been a lot of talk about the growth of, the growth of capital or increase in capital flowing to index funds, and the fact that index funds, and particularly BlackRock, State Street, and Vanguard, now generally own over 20% of most large and mega cap public companies. And these index funds, what's very interesting about them is they obviously have to be invested in an index and they have to track the index. They cannot vote with their feet, so to speak, right? If they don't like the way a company is performing, they can't just sell their shares and move on to another better performing company. And that means that they're long-term investors, and what they believe drives long-term shareholder value is alignment and good managing of ESG risks and also taking advantage of ESG opportunities. So they are becoming more vulnerable, target companies, are becoming more vulnerable to ESG activists or activists who will use ESG campaigns, because these long-term investors that own about 20% of these public companies are going to be very sympathetic to ESG-based arguments. Another lesson that I think we did learn out of the Exxon engine number one proxy contest was that engine number one didn't end up spending a ton of money soliciting the retail shareholders at Exxon. Exxon had a huge retail shareholder base, over 40% of their investors were individual people. And those people are traditionally very hard to get to vote, right? They often do support management when they do vote, but it's very difficult to actually get them to submit a vote. And that should have been a bulwark for Exxon against engine number one, right? These people should have been management friendly, and all you have to do is kind of continue soliciting their vote to get them to vote, and they would have probably supported management. But on the other hand, what was, assisting the engine number one, the activists in this case, was the fact that BlackRock, State Street, and Vanguard, all of whom supported at least two of engine number one's nominees, owned a huge percentage of ExxonMobil. And that's happening more and more with large and mega cap companies, which means that ESG investors don't necessarily need to spend, even if they're going after a company that has a heavy retail shareholder base, they don't necessarily need to spend millions of dollars soliciting that retail base if they can get the vote of these index funds that are already lending sympathetic ears to ESG campaigns. It's considering, one other thing I would say is that, and we have said already that even though ESG activists are not necessarily making their arguments for an ideological purpose, right? It just makes good business sense to have a strategy that's going to take you through the climate transition. But it also is a little bit harder to settle some of these ESG-based campaigns, given that there is this principle in the background there, and the company can't just necessarily throw you a bone, oh, okay, we'll increase our dividends, we'll put in a share buyback program, right? It's really more strategic planning and a long-term vision of what the company is doing that these ESG activists are trying to change. So they might also be harder to settle, and in that way, perhaps companies are more vulnerable to full-on proxy contests as opposed to an activist popping up and it gets settled before the vote.
Amanda, I want to get your thoughts just from what Gabby had mentioned about the index funds the mindset really changing there. Do you echo those comments? Do you have anything else to add in regards to the way that the index funds are sort of behaving when it comes to ESG? I'd like to get your thoughts as well.
Sure. So I do agree with what Gabby said, and I think we're seeing more and more. I mean, from BlackRock specifically, we've seen a significant push this year in terms of letters and vote where they've been putting their votes. I think that we're going to continue to see that more. I think that something that was particularly interesting in the engine number one Exxon situation, which could potentially happen more and more as we see newcomers on the scene in terms of ESG activism, is that engine number one owned a very small stake in Exxon, and they probably, or I mean, I could say I don't think that they were taken seriously at the get-go from the company, and even via the news, people thought who was this this new investment firm no one had ever really heard of. They launched the firm, a few days before they launched this proxy campaign, but it really goes to show that if you have deep relationships and have a strong argument that makes good business sense and environmental sense, and show the intrinsic link between the two to those big shareholders that are, as Gabby said, ultimately in at least 20% of almost every large corporation, you can move the needle. I think, even I remember talking to a reporter once, and the reporter gave an anecdote saying that this was really changing the landscape of activism, in that when we look back at the corporate raiders, if you didn't have a stake in the company that actually meant something, that was, a 13D worthy and 5% threshold, or even, in a huge company, almost 1%, people sort of didn't bat a lash at you and sort of put their head down and moved away, or potentially ignored shareholders. And this basically showed that you can't do that anymore. And if you have the ability to bring those other big shareholders along with you, that, you can win proxy contests, and you can begin to make the change between environmental and business sense over the long term.
Still wondering how many little engine that could jokes come up with this, but we'll save that for a different conversation. Andrew, do you have anything else that you can add? Is there anything else that you'd like to share on this topic before we move to a different one?
I think we covered it pretty well there. The key part I keep hearing is this alignment point. It's amazing what can be achieved through that. But yeah, no, I think we covered it.
Absolutely, great. So Andrew, I do want to stick with you just on our next subject here. I wanted to get your thoughts on how ESG activism returns compare or really compete with that of the regular activist strategy or the activist investing strategy. Do you think that there are any sort of differences or evolutions to the strategy going forward?
That's interesting. I think it relates definitely to what Gabby said earlier. To be clear, there is altruism in the world, but not in this area. It's about good ESG is good business, and if there's going to be campaigns, there needs to be outcomes which are clear and material, given the risks associated with it. But no, I'll put it this way: there's nothing really unique in an ESG strategy versus conventional strategy, in that if there's an opportunity for change and that's identified, if it's successful, either private or a public campaign, if it's successful, there'll be an outcome, positive one, and that will translate into some kind of return. So it's either a shift in the cost of capital, equity valuation, or value release. And this is what we went through in the paper, spent some time on this concept. What was the nature of the return? Well, actually what changes is not the level of the return itself, right? The return will be the return. What changes is the chances of success. So what I think we're looking at with ESG, because of the alignment that we keep referring to, alignment of values and consistency of view, how that mobilizes capital to act uniformly and efficiently, is that the risk-adjusted return goes up. If you're more confident about getting the result that you're going to get, the return will be the return. But if you've got lower risk associated with that, okay, and you've got a better chance of that outcome. That's very attractive, and that makes that's pretty rare to be confident of how certain investors will behave. That predictive nature of investors who obviously in normal circumstances and all other aspects would pride themselves in acting in a differentiated fashion. But if you can be confident how they're going to behave, then you can have a greater confidence about the outcome, and that will mean a lower risk of failure and a higher risk-adjusted return. I think that's the way to think about it in the context of the ESG campaign.
Absolutely. Thank you for that. So I want to change gears here and look at sort of the defense that companies could administer when being posed with activist investing, right? And Amanda, I think we'll start with you on this question and hop around the room as well. But we've mentioned Exxon many times already, but are there any other companies, or for that matter, any industries that you can think of that are susceptible or vulnerable to ESG activist investing? And what would you say are really the reasons for this vulnerability? I know we went into it a little bit before, but I'd love to get your thoughts on sort of if there are specific industries or if there are sort of maybe specific sizes of companies that are vulnerable or susceptible to this.
Sure. So I think, look, big picture, there are obviously the very obvious industries that are susceptible to this, such as, ones that are screened out of, ESG friendly investing. So oil and gas, tobacco, those automatically come to mind. I think that, however, almost everyone is vulnerable, or every type of company is vulnerable in some capacity. Particularly if you go back to what Andrew was saying earlier about supply chain, I think that there are a multitude of ways that companies that we would think maybe have a very low carbon footprint might be partnering with companies that don't. And how really, if you are looking just beyond the companies themselves into the way that they are partnering with other companies, they can really make big differences via small changes. I think that there needs to be more transparency in terms of the results that companies are reporting, and more frequently, because a lot of times we're only seeing things in once a year CSR update.
Yeah, absolutely. And
go ahead, please, Justin.
No, I was actually going to throw it over to you, Gabby, if you don't mind.
No, I think that especially companies that, as Amanda said, every industry is vulnerable right now, especially companies that are not keeping up with their peers. I mean, one thing we have heard from investors, index funds and pension funds that, again, are all long-term shareholders locked into these companies, not selling, they're tracking an index. Even if companies are making strides towards improving their performance and improving their metrics, improving their targets, right, for what they're planning on, reducing emissions or reducing workforce turnover, investors are still looking for continued improvement over time, and also improvement. They're looking to compare each company to their peers within their sector and their industries. And companies that don't keep up with their peers, even if they are making improvements by themselves in their own little vacuum, are going to be vulnerable. One thing we haven't talked a lot about today yet, we've talked a lot about ESG activism, which, I mean, it probably people mostly think about proxy contests, right? So contested director elections, right? When an activist is trying to get its own nominees on a board of directors of a company. But the other side of this that has been going on even longer than ESG activism in the sense of proxy contest is shareholder proposals. And, we have seen all the index funds and many of the pension funds willing to support shareholder proposals calling for more environmental and social disclosures, better targets in the coming years, things like that. They're supporting them even when the companies are making improvements, even when the companies can point to fulsome sustainability reports and, improvements in their metrics and targets over time, because what these index funds and pension funds are looking at is, we're not looking to reward companies for their past conduct already. We're looking to compare them against their peers. If they're not doing as well, if they're falling behind, we're going to vote for the proposal. And they're actually, even more than that, they're voting for proposals if they think there is room for improvement, regardless of how the company's peers are doing. So the line is continuously moving, and all companies are going to be susceptible to pressure from their shareholders to keep up with this continually moving bar.
Gabby, I want to just jump back to something that you mentioned earlier in your response, because you mentioned companies' peer groups, right? And I understand, being within the same industry or similar industries, but do you feel at this point that the peer group is just expanded to having a clear, very strong ESG message, as opposed to just being somebody that's in the same industry, right? Do companies have, or are companies are being compared on an ESG level regardless of what the industry is? Does that make things difficult? I don't know if that was clear.
That's an interesting question. To me, that's a question about, right, how much does the narrative make a difference to investors versus just the pure metrics and comparing metrics against peers in their sector? That's what I'm understanding from your question. And I think the narrative does make a difference. Metrics, right, numbers tell a story, but they only tell, they don't necessarily tell the story the company wants to tell. So companies should be taking advantage of the opportunity in their sustainability and CSR reports, and also in engagements with investors, to explain, the story of how boards choose their targets, how they got to their metrics, how the board is overseeing a company's performance in the various ESG areas, and how they're looking at ESG risks, and also trying to take advantage of ESG opportunities, which is the other side of the coin that hasn't been as mined yet, let's say. And investors are open to hearing a company's story, and I think will be more sympathetic to companies who try to explain a little bit, even if they haven't met the performance standards that an investor wants to see, but a little bit of explanation can go a long way. In terms of, companies that are getting compared to other companies outside of their sectors, I think that's probably happening a little bit less, but perhaps we'll see that over time. I don't have a crystal ball, but, only time will tell.
I want to jump to Andrew, because I want to get your thoughts on this as well. Given Gabby's response, Andrew, do you feel similarly? Do you have any thoughts regarding this?
I do, absolutely. I think the point about peer groups is really key. So the analysis tends to be within sectors, and those sector peers are often defined traditionally by index approach, and companies have little choice over that. I think there is a tendency to look beyond that for two reasons. One, to be able to judge their own performance better in a broader context, and also to look at things perhaps aspirationally, to say what companies do we want to judge against. So this works two ways: one, for investors to judge companies, and others for companies to judge themselves. And to this point, really the only way that people have been able to do that is been looking at third-party rating agencies, which I think has got a number of flaws attached, or shortcomings, the necessary elements of what they do. But but you talked to us now, Gabby, about things needing to be sort of real-time or up-to-date, forward-looking, and it doesn't seem to work that well on that basis. And you talked, Amanda, about targets and the need for for companies to be better. Who was vulnerable? I think we started this part of the discussion around that. Who was vulnerable? And definitely those that aren't disclosing are vulnerable. Some of the work we did in the paper was to look at who is disclosing properly on emissions, and it seems like only 58% of companies are still not properly disclosing on all the range of emissions that they could. So that's the biggest, most transparent area of disclosure. And actually, when you look at targets that are associated with that disclosure, it's even less, close to 72%. I mean, like there are big gaps. Huge progress needs to be taken in this area, and I think those are the ones that are most vulnerable. But companies that are not focused on their own performance, not able to assess it properly, and not rising to that challenge. So I think there's the vulnerability is pan sector, across sectors.
I want to stick with you, Andrew, and just get your thoughts here with the amount to disclose, right? With all the different parameters, you mentioned about 58% of companies not disclosing emissions correctly. Is there sort of a good precedent to set in terms of what companies should disclose or what they could be disclosing within the realm of a proper ESG report? Does that spectrum just get wider and wider with the amount of information that ESG could cover? Does that make sense?
Yeah, it does. Yeah, it's a very real problem because you've seen a proliferation of standards and frameworks, regulation with that following on. And that's a great burden for industry, particularly with a size advantage, right? So if you haven't got the resources to adhere to all these frameworks, then you're all the time making compromises and judgments that will have some kind of cost. It's very difficult for companies to know what those choices, what the best thing is to do, and to feel that they are failing at every turn. And that's sometimes to do with size, also to do where they are in the cycle. Obviously, all those that are recovering from the pandemic in different ways, this is a very resource-constrained area, and yet there's constant increase, demand, expectations are higher and rising, and so how to meet that challenge? The answer is, there's a range of answers and they're very specific, but actually the answer is to do as much, to make a start and to do as much as it makes sense for the business. Most companies know their own business well enough to know what it is practical to disclose, and to start as they do that, the engagement with their key investors to hear about how that's appreciated. And almost any disclosure is good, but they should not feel that you have to disclose everything and feel that to fail to do that is somehow going to compromise their situation. A lot of this is about intention and about we need to see real progress, but that only comes from making a start, making it credible, transparent, accountable, and from there they can grow. I think that's the way forward.
Absolutely. So we're getting sort of into the conversation of defense here. So I want to toss this over to Amanda and get her thoughts. How are companies positioning themselves to defend against ESG activists, right? How are companies responding to the need of ESG messaging? Amanda, if you'd like to share.
Sure. So I think something that Andrew just said is really key to this answer, which is engagement with shareholders. In addition to, companies probably having some sort of break glass deck or being prepared for an activist that might come knocking at their door, and just really monitoring their investor base and, being prepared for what that might look like. I think being keyed into the investor base, taking questions from investors, being transparent with them, engaging with them is critical. I think that, frankly, a lot of what happened in my personal opinion, what we saw with the Exxon engine number 1 situation, the proxy fight, was that there was a lot of engagement that was not happening with investors, or shareholder proposals that were ignored over time, as Gabby touched on earlier, that might have passed but weren't really put into material action. And in order for companies to really protect themselves in some way from an activist coming and, knocking on their door and really launching a proxy contest or getting to that next step is engaging with them and really trying to find common ground and taking the criticisms and being transparent in the improvements that might not have been disclosed, but that were being worked on behind the scenes. I think that's something that's very interesting that typically happens. The typical activist playbook is if there is an activist situation and it does turn into a proxy fight, you'll start to see the company announce things that they apparently always had planned, and they were about to do this, or they just announced that, and it always seems to happen that way. And there are conversations that can be had with investors, obviously privately, if you have that dialogue with them beforehand, and perhaps they weren't privy to some of the things that were already being worked on, and finding common ground ahead of a full-blown campaign.
I was just going to say, does this cause some companies that may not be targets right now, but does it cause them to sort of scramble to figure out what a lot of this is, and maybe act hastily when looking at prior proposals that have been ignored, or stuff that they can look back on and say, wow, this was something that was brought up earlier, we probably should act on this? Do you feel that that the Exxon situation is causing some companies to sort of scramble and think about this? I want to stick with you, Amanda, on this.
Sure. Look, I can't say for certain, but I think that if there's one piece of advice that I would give to companies, it is you can never be prepared enough for these types of situations. And, as much as there are, these break glass decks that I said, or preparedness plans for these situations, they ultimately will get thrown out the window if an activist comes knocking on your door. You never really know what to expect. But I think if you're looking at what's going on in our environment today, if you're looking at engaging with your shareholder base, if you're looking at being really transparent in terms of your goals and objectives and following through on that, particularly, giving updates, giving guidance, giving the most information that you can on these issues, and being transparent in that, you're preparing yourself more than others, maybe.
Absolutely. Gabby, do you want to chime in? Is there anything that you might want to echo from Amanda's comments? I'd like to hear your thoughts as well.
Sure. I would happily underscore what both of the other panelists, Amanda and Andrew, said, which is that engaging is an important year-round exercise for companies. Credibility is not built in a day, and it's much harder to build credibility with an investor after an activist has shown up in your stock and has given thorough and thoughtful criticism of your ESG planning and managing of ESG risks. Companies should be talking to their shareholders over time, especially their long-term shareholders, their index funds, and allowing those shareholders to meet with independent directors separate from the management team. That is actually another lesson that I think we can learn from the engine number one Exxon proxy contest, which is that for years, Exxon, well, there were rumors, so I can't say for certain, but there were rumors that for years Exxon was refusing to allow some of their largest investors to meet with independent directors without the CEO present. And that really undermines credibility, right? First of all, it's a little bit like, what are they hiding? What are they afraid that these independent directors are going to say when the CEO is not present? But also, when investors want to talk about executive compensation, for example, it's an uncomfortable conversation to have when that executive is sitting in the room. And you really need to build up the credibility with these investors, the people who are going to be making the voting decisions when and if an ESG activist comes into your stock and puts an interesting vote on their ballot. So totally underscoring that, engagement and building credibility over time is absolutely key here. That's really the best defense.
Right. I was going to mention if you had any other sort of ideas on best defense mechanisms, but to your comment, the credibility isn't going to show up overnight, right? That's going to be something that has to be built. Are there any other sort of defense mechanisms that we can think about, short term, even versus long term? Anything else that you'd like to add?
I mean, this is not necessarily a new thought, but I guess a continuation of this engagement thought, which is that when you engage with shareholders, when an issuer engages with shareholders, it shouldn't just be the issuer telling its story. It is very important for the issuer to explain its story, explain its plan, how it came to its plan, which is something that, particularly index funds and pension funds are interested in hearing, right? How the board made the decisions that they made, right? What was their thought process? How did they come to it? Was there a particular committee that's in charge of it, or was the whole board involved, et cetera? But also the idea that, excuse me, I just lost my thought, my train of thought. I think we're going to need to edit this a little bit. I'm sorry.
That's okay.
Shall I pick that up?
Yeah, Andrew, you want to jump in?
Yeah, go ahead, please.
Yeah, so you're asking about best defense, and I think each situation can be different. But I think one thing came through in the paper was about complacency, and I think we touched on some of this, but the greatest risks are the unevaluated risks, and companies that are confident about their position need to challenge the basis of that confidence, because we're finding that some of the data or the feedback loops that they have, they're reinforcing their own perception of themselves, that they're either, if not immune, and certainly superior in certain aspects, are exactly the ones that run into it. There are examples we talked about today, and these will be the examples of tomorrow, where we see companies that seem to be riding high on their own success, and in fact, are exactly the same ones that are going to be challenged. So I think it's about that's a cultural thing that companies need to address, what it is, where the risks truly lie in this area, and to recognize that there's that gap between maybe they do have a strong strategy conceived and executed and internally within the business, that maybe the culture's good. But if there's a gap between that and the external perception, then they leave themselves vulnerable. So it's about addressing that inconsistency. I think that's something we're seeing time and again.
Can I just add in one thing there? I think that something that Andrew just said is really interesting, and I'm not going to say which, but Gabby and I worked on a proxy fight a few years ago, and I think that the worst defense that you could potentially give is being defensive, and thinking that you cannot be in any way wronged, that there's not anything that you can do differently, that you have a plan in place that is going to be successful, even if it's not proving itself out yet. A good defense is to not be defensive. So I think that that's a really important point, and to be able to, again, engage, but also take the criticism to heart and try to work with it rather than be defensive against yourself. It will come back to haunt you, and it does not do well by investors.
Very
adding on to that point, underscoring this idea about engaging, right? Engaging is not just the company telling its story to investors, right? The board members meeting with investors and explaining how they chose their targets, how they're overseeing meeting their metrics, what committees of the board are involved, or if the whole board is involved, what are the skill sets of the board members that are helping the board members properly oversee ESG risks and taking advantage of ESG opportunities, but also listening, which is, I think, what Amanda was getting at also. You have to take the time, issuers need to take the time to listen to hear what their investors are saying. A lot of unhappiness in the shareholder base can be gleaned from conversations with investors in advance of an activist showing up. If an issuer just really takes a second and hears their investors out, and also it happens to make the investors feel good to be heard, because actually at a lot of these, especially at the index and pension funds, a lot of the folks doing the voting are women in their 30s, not necessarily all women in their 30s. There are definitely a range of ages, but many of them are. And they often feel marginalized by, boards that are, and this is changing, but boards that are white and male and older. And just allowing these people to feel heard, these, governance and stewardship teams to feel heard, will go a long way, and you will get important information about what your shareholders are thinking. And that can be done well in advance of an activist showing up in your stock. So that is also a really important part of a good defense.
I was just going to say, Gabby, that the amount of information that you can take in will never be invaluable. It will always be valuable. It will always be something that is, knowing is half the battle, right? That's really kind of the crux of that. So with the time that we have left, I do want to ask a final question of everyone. And I want to start with Gabby. I'll start with you on this. Is this strategy, the ESG activism strategy, sustainable? What would you say is the end game at this point? And I want to we'll go around the room and get everyone's thoughts. But Gabby, if you'd like to start, that'd be great.
I think so. I think the world is moving towards recognizing that these, environmental, social, and governance issues do have a connection to short and long-term shareholder value, and that it's important to, manage risks related to these things. Important to have a good strategic plan in place related to these risks, and to take advantage of the opportunities. I will say this, however, I think it's very important. We have already seen short selling in the ESG space, and we have already started to see backlashes in the space from activist investors who are going after companies who are investing in ESG, topics. Let's say, they're making investments in environmental and social areas of the company, but they're not doing a great job in showing how those investments are tied to the bottom line, the fiscal bottom line. And that is a really key part of ESG, right? ESG is not charity work. It is supposed to be, financially material. And to the extent that an investor can see a company's investment in environmental or social area, and the company doesn't do a good job of explaining how that investment is going to be valuable to shareholders, increase shareholder value in the short and long term, they're vulnerable to attack, because there's a lot of other things that companies can do to invest. The obvious examples are dividends and buybacks that are immediately valuable to shareholders in the short term. So I think ESG investing is sustainable, but I think there will be ebbs and flows, and companies need to, ESG activism is sustainable, but there will be ebbs and flows in how investors react to companies, managing ESG risks and opportunities if they don't do so with an explanation that makes coherent sense in a long-term strategic plan that builds shareholder value.
Amanda, same question here in terms of sustainability and the end game. If you'd like to share your thoughts, that'd be great as well.
Sure. So I agree with what Gabby said. I do think that if we're looking at a bigger holistic picture here, there is the potential for, ESG is a buzz term, buzz acronym right now, and there is the potential for that to slowly go away. I think that if, and more just investing encompassing ESG as it comes to the forefront. I think that if we're looking at what ESG investing means to some investors, for some it means screening out all the bad and just focusing on companies that are already doing what they should be. But ultimately, those companies that are doing poorly are not just going to die out; they're going to still remain. So I think if we almost shift what ESG investing means to, investing in some of those bad companies, that could be ESG investing because you're trying to change them for the better, then we're really creating a whole new system of what investing is to encompass ESG. So I think that, yes, it's sustainable. Do I think that it will change and potentially parts of acronyms will go away, and what ESG investing actually is could potentially change too, because it might be investing in the bad rather than in the good to change it to be good. But I do think that it will remain, but we're going to see shifting dynamics over time as well.
Andrew, would you agree with what Gabby and Amanda has said? What are your thoughts on sort of the end game here?
Yeah, I mean, I think it's a long end game. In many ways, there's so much needs to be done, so it's interesting to talk in those terms. But no, there's some important themes and developments we need to see. I think ESG activism in one aspect. I think it's by nature. I think people should recognise that there's a constructionist approach that is going on. It doesn't have to be adversarial necessarily, and they're looking to create change and value uplift. It can be done in many ways. At the same time, I think some of the exclusionary approach to investment, I think, needs to evolve because there needs to be stewardship of difficult industries. And so I think there can be innovative ways to do that across financial structures and instruments and vehicles. I think we'll see that be exactly a part of this. But bottom line is that sustainable companies, companies that are sustainable over the long term, are ones that think in a sustainable way, and so sustainable investment should work. It's interesting what you say, Gabby, about the short selling. I think there's obviously where there's a scarcity of investment opportunity, things can become overpriced in the near term, and then and the alignment in that we had between perhaps intent and investment returns is currently as strong. And if that breaks down, then we could see the success of this area maybe be challenged if you're not seeing the returns from the investment in a predictable way, and that because of the way the assets are revalued. But the theory remains that if you invest in a sustainable way, those same companies will outlive their peers if we do that work properly. But ultimately, we're talking about ESG investment will ultimately become investment as that process of investment becomes fully integrated. It becomes more mainstream over time. It won't seem a specialist kind of investment style, and the same is true of activism. At the moment, it's quite distinct when you can see a campaign or an opportunity that may relate to this. It's one that we can point to it and say that's what that's about. But if good business is sustainable business, if ESG investment is sustainable over a long time, then ultimately ESG activism will become another form of activism, and it will fold in on itself. I think that's a long way down the road. In the meantime, because of the inefficiencies and the inconsistencies that exist in this particular part of the market, whether it's about regulation or framework, or whether it's about communication or where you engage with investors, there's so much that companies are trying to navigate. For now, I think it's going to remain a distinct and very powerful dynamic within investment. Yeah.
Well, that's pretty much all the time that we have for our discussion on ESG and activism. I just want to say a very special thank you to everyone for joining us today. Thank you, Gabby. Thank you, Amanda. Thank you, Andrew. If you'd like to learn more about ESG and activist investing, please feel free to visit Investor Update for that white paper on ESG and activist investing. And as well, if you'd like to learn more about Cision's insights product on ESG, feel free to visit Cision as well, and their insights page on ESG offerings that we have and services and offerings that we have. Thank you so much, everybody, for joining us. This was a thrilling conversation, really, really smart, very, very forward thinking. And I want to have more of these conversations in the future. So please join us again, Gabby, Amanda, Andrew. We'll have to have more of these in the future. And I think there's going to have to be more of these conversations because the landscape is ever changing and shifting. So once again, thank you, take care, and we'll speak to you again soon.
Thank you.
Thank you.
Thanks for having us.